As expected, the Fed cut their federal target rate by 25 basis points. This makes 100 basis points of cuts since September. In addition, the Fed revised their summary of economic projections, aka the dot plot. They indicated that next year they would expect only 2 more cuts. This is a revision down from the 4 cuts they had projected in September. The Fed, this was expected because leading up to the meeting, committee members had indicated that they realized that rates were restrictive, but they still wanted to remain cautious as the economy is still pretty strong and robust. Fed Chair Powell indicated during the course of his press conference that he was comfortable with the economy. Growth is strong. Unemployment remains low, although they are concerned about it. Inflation, they've made significant progress, although it has moved sideways. Nevertheless, he's decided it was the right move to cut 25 basis points. The vote was not unanimous. One voter indicated that they would prefer rates remain the same. I think Powell really wanted to lead the horse to water and let markets know that a pause is probably likely come January. He admitted during the meeting that the vote was a lot closer than he would have expected. When you look at the summary of economic projections, in addition to the dots coming from 4 to 2, the committee indicated that there is still significant risk to the upside with inflation, and they want to remain cautious. The bar to cutting rates is now higher than just saying rates are restrictive. Throughout his tenure, Powell's been very transparent with markets in what his next steps will be, especially when there's going to be a departure from that move. So I think he really wanted to lay it out there that we're going to take a pause in January and reassess the situation next year. I think in the scenario the Fed laid out, financial professionals should get used to the fact that rates might settle in to this higher level of rates than they've been used to in years past. The bar for cutting rates, again, is much higher. And this is obviously absent some sort of risk-off events which would send rates lower. But the Fed indicated they believe the economy is strong, growth is strong, unemployment is low. So I wouldn't expect any rate cuts anytime soon. I think there'll be a range, and I think you should expect rate volatility because coming into the year we will get a new administration. We do need to see what their policies they will implement will be. And I think in the first half of the year, we will have high interest rate volatility, but I don't think we'll have lower rates at all. If you look back to the start of 2024, the market was expecting 6 to 7 rate cuts by the end of the year, which equates to about 150 to 175 basis points of rates. Now, we did get 100 basis points of rate cuts, but that was in a much more truncated fashion than I think people expected. It came very, very quickly. And looking forward, we might not even get to the 150 basis point level next year. We just don't know. The economy never slowed down. We expected some sort of slowdown. It just never happened. It was fueled by the consumer. Now, there's different levels to the consumer, but the higher end consumer, the upper income cohorts, they really supercharged the economy. If you were able to get a mortgage less than 4%, if you don't carry credit card debt, the impact of higher rates wasn't as severe on you. And I think that was underappreciated by the Fed, so the economy never actually cooled. When we did get cuts, it was really based on the Fed's fear of unemployment ticking up. That wasn't what we were thinking at the beginning of the year. But towards the end of the year, the Fed really got concerned that the pace of the change in unemployment was picking up, albeit from historically low levels. So that's why they cut. It wasn't because of recession. We still don't think we're in a recession. It was because of unemployment. So again, what does this tell us? That predictions are extremely hard, but reality when it comes to the Fed, it's kind of a fool's errand to look more than 1 or 2 meetings out what the Fed's next move is going to be. As we move into 2025, the Fed's going to look at a couple different things. As always, they have a dual mandate: price stability, which is inflation, and full employment. They believe that they have a handle on the inflation situation. However, they're more concerned about unemployment. As we've noted, the consumer has been really strong, but eventually the consumer will slow. And again, lower income cohorts are definitely struggling when it comes to the higher cost of goods. That will catch up to growth, which will eventually cause an uptick in unemployment. But the problem is we just don't know how long it's going to take to catch up. But that's what they're keeping their eye on, as the consumer. In addition, we have a new presidential administration coming in the first half of the year. They are very keen to see what their policies will be, what the execution will be, and the impact. They just don't know. They're starting to incorporate those into their models. They admitted that as much in the meeting, but that's really going to be really a key factor for what drives their decisions in 2025.